Valley Bank posting slightly better than expected earnings. It had revenue growth of 8.7% year over year. That comes after regional bank stocks saw sharp drops last week because of growing concerns about the health of lending businesses. Joining us right now is Ira Robbins. He is Valley Bank CEO. And Ira, thank you for coming in today.
Great to be here. Thank you so much.
I just want to take a look. I don't know if we have the stock chart back there, but if you're looking at a year-to-date of Valley versus the Spider S&P Regional Banking Index, you have sharply outperformed your competitors. I think at this point, up by 16% versus decline for the overall index. What are you doing that other banks are not?
Well, I would love to say it's something that we're doing amazing within the organization. I think if you extended the chart a little bit further, you would see a pretty significant decline in Valley stock in that year prior.
Oh, I like the honesty.
Yeah,
here.
don't
Let's talk about
the
this.
ixnay on the honesty.
Yeah.
Okay, I'll try to
Let's talk about that. What happened? Where was Valley before?
I think
What's
it's a
different now?
microcosm of what goes on in this country, right? There was an overhang about commercial real estate exposure.
Yeah.
Valley has a significant commercial real estate exposure, a lot here in New York City, a lot just across the country. And every press release that you would read, commentary here, talk about the demise of commercial real estate and what a horrible asset class that it is. If you go back to Valley, we've now posted 7 quarters in this commercial real estate crisis with cumulative losses of only 57 basis points. Right, you look at the large banks, you're running 9%. So there was a lot of overhang, a lot of concern from the media and everyone else that there was going to be a lot of losses in our portfolio. And I think thankfully now you look at the stock, people are beginning to see that the losses never materialized. And maybe commercial real estate isn't such a horrible asset class.
Why didn't you have the losses that the big banks saw?
I think it goes back to knowing our borrower, right? The banking industry is an amazing industry when you think about it. You have small banks that cater to a certain segment, regional banks like Valley, we're the 25th largest in the country, that caters to a certain segment. And then you have the large banks that cater to really conglomerates, private equity funds, and different things like that. You know, for us, we know our borrowers. The character of the borrower matters. The personal guarantee of the borrower matters. Our ability to understand the geographies and the corners of which we're lending on really matter. Great for the country, great for a bank like us.
What percentage of your depositors are $250,000 or less?
Right, so we have about 70% of our depositors that are less than $250,000. We have a very strong retail network. The bank's been around for about 100 years. We've never had a losing quarter ever in 100 years.
That's because the FDIC
There's been something floated, a $10 million FDIC.
So I love this conversation.
That would help regionals because, remember Janet Yellen said, I'm covering everybody, basically, during whatever that was.
The sovereign bank.
Right.
Yeah, Silicon Valley, whatever it was. It was an implied moral hazard that you didn't have to worry about anything because Uncle Sam's got your back. I don't know if they really did. If everybody needed it, it wouldn't work. Yeah. Do you think it'd be good or bad if the FDIC got raised? Would it make you less?
I would say from an America perspective, it's critically important. You go back to the great financial crisis, 2008, 2009.
So go to 10 million on FDIC?
Let me just explain to you for a second as to why this is really important. If you go back to 2008, 2009, we saw massive challenges within the large money center banks that really drove the entire industry down. And we went to a temporary guarantee, which was critical to convey the trust that was needed within the banking industry.
Yep.
Ben Bernanke in 2010 in front of Congress talks about when he gets questioned about the moral hazard. And the greatest moral hazard, according to Ben Bernanke in 2010, was too big to fail. So what have we seen in our country now? We've seen an implicit guarantee given to the large institutions. They had 22% of consumer deposits back in 2010, 44% of consumer deposits today.
Because the expectation is that the federal government will protect the big banks because they are systemically important, but they will not protect the small banks, the regional banks, because we have to allow some banks to fail in order to not have moral hazard.
Exactly. But what happens is, if you think about it, if all the credit decisions are made in 1 or 2 or 3 large organizations, how do you think about wealth distribution? How do you think about the economics and ability to disperse capital across the industries that I was describing before? From an American consumer perspective, from an entrepreneur perspective, they have to make changes because the implicit guarantee is putting all the products, if you think about what deposits are, in one organization.
The FDIC is self-insured. The banks insure themselves on that. Right. You all pay for the funds that go into that. So would you be willing to pay more money to have a higher threshold?
I think we would be willing to pay more, but I think in reality what should happen is the large banks should be paying their fair share. Think about any business. What's the fair share?
That's what I always
think about any business that gets
run today. Should everybody pay the same percentage?
Absolutely not. If you have an implicit guarantee from the federal government, you should be paying for that.
I thought
we're
we ended
basically
too big to
paying for it.
fail. We didn't.
We did not, no.
No, we haven't addressed it. If I'm a member of Congress, I'm agitated.
So
with the
you want
regulators.
you want FDIC of 10 million.
But he wants the big banks to pay a bigger portion.
I think it should be.
But it wouldn't apply to them, I don't
for
think.
payroll and transaction accounts.
In what was being proposed, it was for the.
Right. What was proposed by the Haggerty bill
Yeah.
limited it to the non-SIFI banks across the country.
regional.
Yeah.
Right. Because they already effectively have it, but they're not paying for it.
The Journal wrote just a
But you're,
piece
so you're not in
on
favor
how
of
bad
that.
That was an
would've-
editorial written by the large banks, by the way.
It was written by the large banks.
You look at what BPI and some of the others have done, and they are definitely
against this.
influencing what this looks like. Because if you think about your business, if your cost of goods costs you less than what it does for someone else, why do you want to change?
So you're saying they already have this implicit guarantee from the government, and you're going to be forced to pay for it yourself.
Our cost of goods costs more than what they do.
That's an interesting argument.
And when you
We
think
talk to
about the big
banks a
picture of the
lot.
country, once again, that's not American to have all the deposits sitting at 4 large banks. That makes no sense. And that's a trend that we've gone to. I think there needs to be some rational conversation.
That op-ed piece said 99% of banks at the regionals are under 250. But you said you've got 30% above 250.
Look, we bank some very large clients. I mean, the challenge is, if you think about it from a practical perspective, nonprofits is a great example. We bank a lot of nonprofits in the markets that we serve. And nonprofits have educated financial people that sit on their boards. So if you're sitting on a board in a financial crisis, are you saying, am I keeping my money at Valley or am I keeping my money at JP Morgan?
Right.
Right? And those are the decisions. Now, in reality, JP Morgan's not giving them the loan for the assisted development center that they need. JP Morgan's not giving them the working capital to support the autism programs that they have. Banks like Valley are. But we need to recognize that if we don't have the deposits, we can't give those loans.
All right, let me run through some questions quickly because we're trying to wrap us, but I've got more to ask you. First of all, where do things stand just in terms of sound underwriting standards for credit? Because that's been a big concern with the regionals lately. Where are you, and where do you see the rest of the industry?
Like I mentioned before, Valley's never had a loss. You look at the banking industry today, the amount of capital that sits in it, it's never been greater. Credit quality is really good. I think what we're seeing, though, is loans to non-depository financial institutions, which is really creating the issue, right? So those are loans that have really been spurred because of what's happened from a regulation perspective. You look at what happened in a regulatory environment, and the construct is let's keep bad loans or potential risky loans out of the banking sector. Mm-hmm. When you do that, there's still a need for these loans. You create intermediaries now that lend to this space. And what have banks done? They've now lent to these intermediaries. You look at what regulators are thinking about now, and the concept is let's be more inclusive and bring these loans back into the banking environment. Mm-hmm. It's better from a CRA perspective. It's better from a fair lending perspective. But I would say when you make loans to certain NDFIs that are to subprime borrowers, consumers that have challenges, you're going to have losses in those loans. So it's not so much just the underwriting, it's who are you lending to. If a loan to a subprime borrower was bad when you were doing it, it's still bad if you're doing it through an intermediary.
Let me ask you about the state of the consumer, the state of businesses where you operate. You have 230 branches and commercial banking offices in New Jersey, New York, Florida, Alabama, California, and Illinois. What do you see in terms of demand? What do you see in terms of the strength of how these companies and business and people are feeling?
Tariffs have been something we've bantered about for a long time. For us, our clients are strong. Our origination pipeline was $2.4 billion a year ago. Today, it's $3.3 billion of origination pipeline, massive demand across the markets that we serve. And I think what you're seeing is tariffs are having an unequal impact upon large companies and small companies. The companies we bank, much more resilient, much more agile. They still need to buy a piece of equipment. They're going to get it done. If it happens in a large company, the bureaucracy takes forever to move some of this forward. And I think we're seeing more demand in organizations.
I almost thought it was the opposite.
That's been the commentary. I think, just generally speaking, we haven't seen it come to practice in the banks and the clients that we talk to.